Mountain Time. That would be 7:30 if you're on the West Coast, 10:30 on the East Coast. This week's subject is, wait a minute, housekeeping. Let me touch on something first. Weekly Profit Talk is basically a short conversation about the things that you can do to make your business more profitable. Profit is defined as the money that's left over after all the expenses that you need to run your business have been subtracted. So you have three components to your profit. One is the money coming in, and that's called gross revenue. Second, the first thing that reduces that revenue is called cost of goods sold, and that does include your labor, including the labor that you pay yourself if you, in fact, do take a salary, for example, if you're an S corporation. So that leaves you with gross profit, and then all the other selling administrative expenses of running your business result in the net profit, and that is the bottom line. And that's what we're here to talk about today. So matter of fact, we talk about this every single week. And again, that is at 8:30 Mountain Time on Wednesday. So this is a question and answer. Matter of fact, let me pull up my little chat guy here. Whether you happen to be tuning in on Facebook, LinkedIn, or YouTube, if you have a question or a comment, pop it into the chat. I'll see it, and I'll do my best to answer it live on the spot. If you do have a question you'd like to have answered live on the air or any other way, of course, any of those three media outlets, pop a comment into any of our social media, and we will get back to you with an answer. Okay? So also be advised that we'll probably bring your best questions into the following weekly profit talk, which again we do every single Wednesday. So what we want to talk about today is the mighty cash flow. Okay. For those of you that are following us, we sent you out an email the other day and have promised to talk about the difference between profit and cash flow. So profit is, as I just explained, what you have left on the bottom line of a profit and loss statement after all expenses have been calculated. Cash flow, on the other hand, is the money that comes in and out of your business during a certain period of time. Cash flow basically is characterized one of two different ways. You can have either positive cash flow, or a negative cash flow. I'm sorry, I want to complete that thought first. So positive cash flow is if you begin the period, and these by periods we're basically talking about accounting a cycle as a month. So that begins on the first of a month and ends on the last day of the month, right? What we call EOM. Well, I call it EOM, end of month. If you have more cash at the end of the month than you had at the beginning of the month, you had positive cash flow, and that's a good thing. Now, what are the things that affect cash flow? Well, that's basically the money that's coming in and out of your business. You're spending money to meet the obligations, the bills, all the little overheads that you have to pay. A big one in the 21st century is software as a service, for example. But you've got advertising and utilities, keeping the lights on, any one of a number of other things, small bank charges, automobile. The supplies, consumables, all these things are expenses. Your cash flows out to buy these things as cash is coming in. And this is the difference between the cash flow of your business and its profit is basically a matter of time. So to measure cash flow in your business, actually the first thing that you look at is your net profit. So you take that figure, your net income for the time period, and then you adjust that in what we call the indirect method for several different factors. One is if you have any costs going out for long-term loans or depreciation expenses, for example, that actually affects your cash flow. either negatively or positively, depending on which way. Credit card spending actually increases cash flow. If you think about the yin yang nature of money and accounting in general, every transaction has two sides. You're probably familiar with the words debit and credit. We basically in the United States and in the world use a double entry accounting method. So, for example, you buy something you need for your business. So, debit side is money comes out of a bank account. I'm sorry, excuse me. Debit side is you acquire the new thing, the asset or the supply or whatever it is. And the credit side, money going down in your bank account. So every single transaction you have has two sides. And for that reason, the credit card payments, you making your monthly transfer, and please do pay your entire statement balance monthly. If you set that up on auto debit, actually, you're going to be very happy in the long run because you're going to completely eliminate interest charges. Credit cards were never really meant to be a long-term borrowing proposition. And in fact, it is one of the worst money hemorrhages. It's arterial bleeding, basically. And I would highly recommend that if you do have credit card debt in your business, I would focus any additional cash that you may have into paying that down until you're able to pay statement balance in full every month. We have that set up so it just automatically comes out of an account. And for that reason, we don't have any interest expenses at all in this business. The only reason that you may need to is if you have to purchase a large asset. I'm thinking, let's say, for example, you're a medical practice and you need a piece of diagnostic equipment. Of course, you may not have $150,000 or $300,000 just laying around and cash ready to spend. So leveraging debt is wise if it's done wisely. One thing is to keep your interest expenses down. So that's a thing that affects cash. Another thing is what is referred to as investment activities, and that is basically your equity accounts. If you put money into the business to pay a bill, then you're basically contributing to your business. And if you take money out to spend on yourself, then that's called a draw or a distribution. And those also affect cash, quite obviously. So these things additionally do not touch the profit and loss statement because equity accounts are actually on the balance sheet. So hopefully we've outlined a few of the differences between the cash flow statement, the profit and loss. Your business isn't, I'm trying to think of a nice way to put this. You should never use the balances of your business checking or savings account as an indicator of how well your business is doing. Just because you have money in there, you may not actually have any business spending that. It's always, of course, a very good idea to hire the services of a professional that can help you understand and navigate. Excuse me. So sorry. Navigate the choppy waters of your day-to-day and month-to-month financials, and ensuring that you're paying the least possible amount of tax. I don't like what they do with the money. I don't want you to spend a penny more than you absolutely have to. And that is the object of the game. So with that, I hope you found this helpful. Please do tune in and join us next week. Let me take a look at my calendar here. And we are going to be entering a new month. We will see you again on March 6th. And again, that is at 8:30 in my beloved Mountain Zone. So until then, have a great rest of your week, an awesome weekend. And if you have a chance, do something randomly kind for a stranger. So until then, have a great day.